forward, and let's try and understand what does it really mean for AMCs and MFs. We've got Sanjay Shah, CMD at Prudent Corporate Advisory Services, joining in on the show right now. Sanjay, hi, morning. As per the recent SEBI notification, incentives only for new investors with fresh PAN from B-30 cities. How much do you think the industry would take hit?
I think it's a very positive move, and if you look at this is an additional incentive which has been announced by the SEBI, and this is in continuation of beyond 30 incentive. If you remember, I think before February 2023, there was a beyond 30 city incentive which was available to all the mutual fund distributors, which has been kept in abeyance by the SEBI, and we were waiting for some new structure to be announced. I think with the announcement of two important things. One is they said that if you bring money from beyond 30 cities from a new investor who is new to the industry, means their PAN has to be fresh to the industry, then they'll give us 1% as an additional incentive subject to maximum 2,000 rupees. Now, this amount is also linked to SIP. So either lump sum amount, or if you open an SIP, then first 12 installments of that SIP would be clubbed and the 1% of that will be given. But overall, I think so. Will not have any impact, or it will not have any impact on the industry. Rather, it's a positive move, and it will help people to do an efforts to bring new investors from beyond 30 cities. So it's overall positive move.
Okay, overall positive. But Sanjay, like you were talking about, the distributor incentive capped at 1% of the first year investment, maximum of 2,000 rupees per investor. How much impact on the yields are expected for the industry overall, and especially if you segregate between small and large size distributors?
I don't think it's going to be a significant amount as far as expenditure on the brokerage is concerned. So as you rightly said, number one is if you look at currently the mutual fund industry AUM, almost 69% AUM comes from the top 30 cities, and the roughly about 30% AUM comes from beyond 30 cities. Now money has to come from beyond 30 cities. The person has to be new, and he'll be given an incentive only on the first investment, whether first SIP or first lump sum. So it's not going to be a huge yield accretive. So if I'll just give an example. We represent the retail of the country. So on an average, we add roughly about 3 lakh investors every year who are new to the Prudent, and we do roughly about 60,000 new KYC. So roughly 20% are the 60,000 people we bring to the industry. Now let us assume these all 60,000 players are from the beyond 30 cities, and their average investment is let's say about 550,000 rupees. Then per investor earning would be 500 rupees, which is annualized about 2.5-3 crore. Now my total revenue of Prudent as a whole is about 1,000 crore. So it's not going to be even 2%. And then assume that I am saying 100% will come from beyond 30. I'm sure 50% will come from beyond 30 cities. So impact would not be very large. For me also, it will not be more than 1%. So I think it's going to be a good thing it will take care of your routine expenditure to meet somebody and convince him to invest. So that's a good move, but it's not going to be hugely remunerative.
But along with that, the commissions are likely based on the AUM values. Will these growth rates continue going ahead, and how are the demand trends looking for tier 2 and 3 cities?
I think overall it's a big financial inclusion efforts by the SEBI by announcing the amount to be paid for bringing new investors to the industry. So I think it will add to the current already, because if you look at the current juncture, mutual fund is a very well accepted product, and within that SIP is I think by default people prefer investing by SIP mode. So I believe that the growth rate of mutual fund industry is going to be very, very robust, and this is an added advantage for that. So we assume at Prudent, we normally say that our AUM should grow in the range of 18 to 20% on an annualized basis. I think the industry should echo the same thing. On a at least 5-year basis, my belief is that the industry AUM also should grow in the range of 15 to 20%.
Right. Sanjay, SEBI has introduced additional commission for distributors onboarding new women investors as well. How much change do you see in the numbers for women investors, and what initiatives do you think the distributor industry is going to take?
So I think it's a good move because we believe that women has to play a very important role in financial inclusion. They should participate in the process of investing. They should also start creating their own corpus by becoming an investor. So I think it's a very, very good move. And country's progress is now linked to participation by women. So that's a very important thing. Now, whether what impact it will have because you are giving some additional incentive for bringing women investors, I think only time will tell. However, for the new woman investor, they have not restricted it to beyond 30 cities. It is applicable to entire country. Anybody bring a new investor who is woman from any part of the country, they'll be getting the similar incentive structure which has been offered for the beyond 30 cities of new investors. So I think it's a double advantage for the women investors who are joining the industry. And if they are from beyond 30 cities, there is another incentive also would be available.
Okay, we also have Feroze Azeez who's joining us on the show to give us some better sense on what these norms and what these announcements from SEBI's board mean. And Feroze, hi, morning. Thanks once again for your time today. First up, let's talk about this exit load cap that has now come down from 5% to 3%. Give us a sense of what the bearing could be on some of these asset management companies and how could this pan out for the industry going ahead?
Good morning, Snehi. Some are hygiene changes. I would categorize this as a hygiene change. Not that the 5% limit was being utilized by anybody largely. See, if you look at how the landscape pans out, you have about 600 odd equity mutual funds, which are active plus passive equity mutual funds, and then you have a few thousand debt mutual funds. There won't be anybody who has absorbed a cap of about 5%. So I personally think this would not make any change in terms of the exit loads being reduced to 3%. In fact, I personally think we did a study which was eye-opener for me because quite a few asset management companies were pitching to us saying that you give us a lock-in product, we will do well. We'll do better because then you have more time. Investor has allowed you 5 years to perform. But when you look at, we did a study of the top 10 asset management companies, top 10 fund managers who manage both a closed-ended fund and an open-ended fund. In an open-ended fund, the investor has the right to take a U-turn and remove his money any point in time. A closed-ended fund is where there's a lock-in or a proxy exit load kind of a situation. The performance of the same fund manager in an open-ended fund was better than in a closed-ended fund. We realized that Indian managers, when having the fear that the investor will go away, they perform better. And 8 out of the 10 fund managers did better than themselves in an open-ended format than in a closed-ended format. So I think it's very, very progressive. Exit loads have not helped the investor. And I think 3% is also astronomically high. But yeah, having that leeway for an exception makes sense. And that's what SEBI has done smartly so.
All right, but Feroze, along with that, now REITs have now been reclassified into equities. The mutual funds will have a wider room to go ahead and invest. But help us understand what will it mean for the retail participation in this instrument and how can it improve the depth of this particular instrument? How do you see this becoming more attractive now?
See, I don't know about attractive. I would always think that the freedom of the fund manager to have REIT in the equity portion is always a great thing. If I trust my fund manager, the larger the canvas I give him, larger the value in terms of higher return or lower risk do I receive. So that's brilliant. Point 2, if you look at REIT in an isolation, I don't think it is done well in India. Right? Global REITs have a lot of money left on the table. Today, a REIT, if you look at it, it's a small portion, 4, 5, 7 listed REITs in India, not more than 6 if I remember right. But the volatility they throw up is as much as equity, but the return they throw up is a little over debt. So does it add immense value on an efficiency basis? The answer is no. If you use mathematical models to evaluate and arrange all the product lines in the chronological order of Sharpe ratio, which is a good risk-adjusted return measure, REITs will be in the second or the third quartile, not in the first quartile. But should a fund manager have a leeway to not have cash in his portfolio, but have something else when he's not very comfortable with the valuations of the segment he's supposed to be operating? Brilliant. But do I think REIT as an investment vehicle has done justice? Mathematically, of course, perception-wise, I'm sure builders won't be very happy hearing this. But on Sharpe ratios, I don't think people can disagree because mathematics doesn't speak two languages.
Right. But Feroze, prima facie, you're saying this will definitely improve the health of the market. I mean, the fact that they've eased IPO anchor investor rules, they're looking to increase FPI participation as well, or rather would aid so. So prima facie, for the health of the market, this would be spelling good news, and also for, some of the niche market plays which specifically align themselves to IPOs.
Yes. Good morning, Aisha. I personally think, like you rightly said, these are very, very sharp and very good moves. They're progressive. See how all the participants think very differently. There are three big participants in the market, right? FIIs, DIIs, and others. Others have both corporates, private limited companies, partnership firms, and the retail. All are classified, unfortunately, as retail or others when SEBI reports the numbers of participation in the capital market. All of them think very differently. An FII is a little more valuation insensitive, but growth very, very sensitive to growth. He doesn't mind paying valuation. That's the behavior, as long as growth is sacrosanct. The domestic institutional investors are very growth sensitive, very valuation sensitive. They don't even buy growth if it is near certain. That's my experience of understanding fund manager psyche. And the retail, till some time back, was chasing his own tail, but now has become very smart. It started to learn to buy low, sell high. So when it comes to IPO market, I personally think each of these participants have behaved in the IPO market very differently. Retail has always bought and sold. The volumes of IPOs in the first 3 days is twice more the free float the company has put in. Retail guys are using it as short-term investments. FIIs are using and DIIs are using as long-term investors. So I think that's so more IPOs should go into institutional hands so that the good valuations are capitalized on rather than you flip it for a listing gain, which is what the retails and others are doing.
The other thing also, Feroze, and the regulator seems to be working on it, and in their words itself, it's a complex issue. The long-term F&O contracts, what could be the repercussions of that if they are to stay, or if the regulator decides to do away with those?
Yes, Aisha, see, long-term derivatives might seem complex. Like regulator has rightly said, it is complex. If I run you through the way long-term options have operated in India for the last 10, 12 years, which I have been a part of this long-term derivative market. In 2012, 13, 14, 15, long-term derivative open interest was greater than 10 years from then, which is today. Okay, which is surprising. Now, if I wanted a long-term derivatives in the global lingo are also called LEAPs, long-dated equity anticipation participatory securities. That's what it is called. Of course, it's a longer story. If your viewers actually perhaps want to understand, then I can take you through a longer story. What has happened in long-term derivatives is that in the exchange on NSE, you will find even 5-year calls and puts. Brokers restrict most of the retail to 3 months of transaction. So in the first few years of the last decade, long-term derivatives were more prevalent. There were several long-term derivative traders sitting in Hong Kong and creating market for long-term derivatives. In 2015-16, I think NSE and in turn SEBI were a little worried about how the illiquid market is shaping up. There were some curves there. During COVID, their margins were increased substantively, almost doubled, tripled overnight. So long-term derivatives took a backseat. Then again, SEBI came up with a great initiative saying that up to 9 months we will call as short-term derivatives. From 3 months, they've moved to 9 months. So today, if you see, even the June option of 2026 is far more liquid than it would ideally be. So 9 month is short-term. Beyond 9 month is long-term. Most investors who would be hearing now, they would not even know that 5-year options are listed. They're not liquid because there's nobody trading. So when SEBI has to solve this mystery of how to bring in cogent, non-manipulative practices in long-term derivative, is it a complex issue? Couldn't agree more with SEBI. Second, if SEBI is curbing weekly derivatives, which are largely speculative instruments because people are using it to buy and sell as per market movement. That is called the delta of the option. That feature is called the delta of the option. Long-term options are very good securities because you can predict Nifty in 5 years. Predicting Nifty in 5 days is very difficult. But if you ask me where would Nifty be 5 years from now, I'd say at least 10% compounded return. Nifty should be at 32,000, 33,000, so that, or 35,000. That's easy. So that's a very good non-speculative instrument with a calibrated leverage. So I think it's complex, but I think there are so many other features, but I'll not bore you too much with it, Aisha, at the moment, unless you have a follow-up.
Right, Feroze, so sounds good on that front, and thanks for all that clarity. I just want to understand on the IPO front, once again coming to that, the anchor investor quota to 40% that has been increased. What could this mean for IPO subscription patterns that we see going ahead? Any influence at all on that?
Yes, Snehi, I personally think that that's very, very important. See, how should the market shape up? I was in the US last week. How FII is looking at Indian market is there is a lot of valuation challenge for the growth some of the stocks promise. So developing the IPO market, good cogent paper coming into the marketplace for anchor investors is the only way India can not have bubbles, can absorb the kind of capital which Sanjay Sir is bringing to the market, right? He's penetrating into tier 2, tier 3, tier 5 cities at a point in time. Where will this money go? Because there's hardly any free float. In S&P 500, you'll be surprised, 90% of the stocks have more than 90% free float. In India, the number is only 6% of NSE 500. 30 stocks have greater than 90% free float. Most of the free float is not there in the Indian market. Promoter as a concept is more towards India. So coming to anchor investors quota in IPO is one step in that direction to be able to buy good quality paper, which is there during an IPO. And I think India is going to pump in at least 50 trillion rupees or 50 lakh crores in the next 8 years, only from domestic institutions. And it's ironical that we as a listed company might be $3 billion having only $1.5 billion of free float, but we will be the 267th company as per free float in India. And I've been listed only for 4 years. I don't know whether I have to be happy about this or sad about it. And mostly I feel sad that a country this large should have more listed businesses and lesser promoter holdings so that bubbles don't form.
Long way to go, Feroze. But with this, we let you go on that. Thank you so much, Feroze, as well as Sanjay, for taking the time out and speaking with us and helping us understand what the SEBI outcomes mean for the industry and how the participants are taking it as well. Well, let me take it across to Chandan as well as Pankaj Pandey and welcome both of them on the show. A very good morning, gentlemen. And Chandan, let me first come to you because Nifty for today and even in